Welcome back. This is the Real Estate Roundtable with IPRG, and it's October 20th. Today we're talking about just the real estate market in New York City. We have interest rates that have gone up, and I think what we want to talk about is how interest rates are impacting the market and dynamics between buyers and sellers, and what market participants should be looking at and thinking about in relationship to their financing and interest rates. So kind of a broad topic, and we'll see what comes up. I think there's some interesting aspects here. But does anyone have any preliminary thoughts to get us going on just the current market related to interest rates?
Yeah, I could start it off.
Luke, start it off.
Yeah, okay. So I feel like as brokers, we're starting to feel real tension in the markets, not just from buyers, but from sellers as well. I think people know what's going on. People can see the writing on the wall that interest rates have gone up a lot. They're continuing to go up. So I think it makes sellers a little nervous too. They're thinking about selling now or in a few months or even in 6 months. They know that they're going to be selling into an environment where they don't really have the upper hand. I mean, interest rates are really going to be going up, and buyers feel the same tension. I feel like these guys have deals under contract. They're trying to put new deals under contract, and they know that it's a fight against the clock. And I definitely feel it on both ends. Do you feel like we're in a market where it's kind of clearly heading downhill, and like we're slowly going down in value, and as interest rates keep going up, prices continue to drop? Yeah. And are we at a point where you can basically say, I see where we're at, and based on everything I'm hearing, interest rates are going to keep going up, which means prices and values are going to keep going down. Cap rates will move up with interest rates. Is that what buyers and sellers are looking at right now? I mean, I don't see, obviously we're brokers, and I don't want to tell anyone the market's going down, but I don't see a lot of evidence to support the market not going down, right? Like everything that's happening.
Yeah, I mean, not broker. Let's just be honest. I mean, dude, when interest rates go up, cost of capital goes up.
Yep.
And prices go down, and I think in large part you're seeing that throughout the housing market. I think you're seeing that throughout a lot of asset classes throughout the economy. It's no big secret. Obviously, we want to get our clients the highest price possible, but there's things beyond our control. And I mean, this is going on macroeconomic globally.
100%.
They're trying to slow down the overheated economy. So I guess my question is are we looking, if you're a buyer or if you're a seller here in October of 2022, are you basically, as a buyer, are you saying, well, interest rates are going up, so in January I think I'll get better pricing, or in March I think I'll get better pricing? And are you sitting on the sidelines and holding back? And as a seller, are you basically saying, damn, I think my property value is going to keep going down. What am I to do?
I think what you just described is the tension. I think there's definitely, we're feeling it a lot from sellers, right? I mean, we're getting calls from buildings we have on the market, what are we doing? Where's the activity? They're pushing because they want to get a deal done, and we're getting a lot of deals done right now at a high rate because of that. I think sellers are nervous.
Wait, you're saying a higher
rate,
cap rate, or
no, a higher, a speed rate, right? A lot of times sellers want the building on the market for a few weeks. They want to field offers, and in 2 deals in particular that I'm discussing, one's a deal in Clinton Hill. We just got the phone with the seller. She wants it done, and we're doing well. We're getting a good number on it, but she's not slowing down the process. She's speeding it up, and she's trying to get a contract out because she can see that things probably aren't going to get better on that front. So she's trying to get that done. And buyers, to your other question, I think some buyers are looking to buy. I think they make money buying deals, and that's their job, so they have to buy deals. But I think that there's a lot of capital sitting on the sidelines because they're just not sure. They're not sure where the interest rates are going to go. They think in the back of their head maybe that deals are going to be a lot cheaper in the first quarter of 23, which is definitely an argument. So I think there's definitely some tension, like I said before.
So, all right. So you think that sellers are accelerating their rate for time on the market and trying to make transactions happen quickly. We saw that in Q3 of this year. So from July to September, a couple months ago, we blew it out of the water in terms of new fees under contract and new deals under contract. We had our company goals, which I think are reasonably lofty to begin with, and we exceeded our goals by 40%.
We did.
It was our best quarter in the history of the company in terms of new fees under contract. And my take on that, I was kind of nervous going into the quarter with interest rates going up, and I didn't know how that was going to impact the sales market. But my sense was a lot of sellers could see the interest rates were going up, and they could see that their values are going to go down. So a lot of sellers were essentially rushing to sell. There was a rush to transact as quickly as they possibly could. And from the buyer's angle, we saw buyers rushing to sign contracts because they knew if they didn't lock in their financing that their interest rate was going to go up, and then all of a sudden they couldn't pay the same price, and then the seller wouldn't sell, and then they lose the deal. So I think a lot of buyers were locking in like longer term financing, and the numbers worked for them. And I think the buyers knew that the values would still continue to go down as interest rates went up, but they were good with their deal. They locked in the value, the numbers worked, they were happy with it. So we had a ton of deals that happened in Q3, and my take was that kind of started to pause after the Fed raised interest rates again. I guess it was in September or October. It was a couple weeks ago. I felt like that really kind of slowed the market down. Maybe all the Jewish holidays was really the reason for the pause in the local market, because all of a sudden here we have it again. Before this conversation, Donal was saying we have significant amount of properties on the market. They're about signing contracts, and you're saying the same thing in a different market. So maybe that's the story of this: is people see the market kind of heading down, and they just want to lock in their transactions.
Yeah, from my point of view, I think our sellers are just trying to get in front of it, and they see what's coming down the pike. There's a lot of news out there. The narrative is like doom and gloom, so they're trying to get in front of it. So they're getting really real, very like in a quick amount of time. So I think that's really pushing us to get contracts out. Now finding the buyer that's going to sign it, I think that's a little bit tough because buyer demand has shrunk a little bit just because the interest rate's rising, and you have less demand wanting to buy these buildings. I think if they just sit on the sidelines, they're probably going to get a better deal. You just have to find, like you said, find the buyer that's comfortable with the deal on the table.
Last week we talked about, what is a better deal? Like, is a better deal just a lower cost basis at a higher cost of capital and a higher yield, but you're paying for it in your cost of capital and you get a lower cost basis? Or is a better deal, maybe you pay more for property and the cap rate is less, but your interest rate is less, and you're paying more, I guess, on a price per foot or price per unit, but like, is one deal necessarily better than another? And last week I argued that cost basis is the ultimate thing you go for in real estate, but obviously cap rate and financing plays into that. So you can make great deals today. So as a buyer, I'm not waiting until January or March or June trying to time the market on the way down to like get the best deal that I can, because the buyers that try to do that are the ones that they always miss out.
It also depends on you're saying what's the best deal. It depends on what that buyer's capital wants, right? Like any syndicator will tell you what's the best deal they can buy. It's the deal that their capital wants to transact on. So if someone's waiting on the sidelines, it's not like they're trying to do that. I think their capital is sitting on the sidelines.
Are we seeing? What about syndicator capital at this point? Is there a lot of syndicator capital, or is it private capital?
I think syndicator capital is what's died down the most.
Yes.
Yeah.
Those are the quietest right now. The people that we're selling deals to, I'd say 70% of the time right now, these are high net worth people. These are people in big 1031s or have sold something. They're operating with a lot of money, and it's not so much like the raised capital that we were seeing a lot of earlier this year when interest rates were very low and they were buying a lot.
Yeah, I just think in terms of the syndicated capital, their money is it's on pause right now. I don't really think they're giving it out to a lot of these syndicators. So I've essentially seen that like kind of dry up. Get tough.
All right. So where are we hearing that interest rates are at this point for acquisitions for multifamily mixed use, not heavily retail or office type of stuff, or not heavily construction, but just like run of the mill, tax class 2, tax class 2B, New York City?
I mean, I see it around 6%. I mean, that's what I keep hearing from everyone else. I mean, maybe sometimes you get a high 5.8% rate, but I'm hearing 6 and almost over 6 now.
And
6 to over 6.
On top of that, I agree with Donal. I mean, I've heard over 6. We've talked to brokers that said that there's banks doing like 5.8s, but I haven't really seen that. But what's really, I guess, throwing buyers for a loop right now because they're signing deals or they have contracts pending. Banks are anticipating rates going up. They're not just they're shooting. They're even going farther. A lot of banks will say, "Oh, I'm in the high sixes," because they're trying to anticipate where rates are. They're hedging.
Yeah.
Where are rates going to go, and that's affecting buyers because banks are also doing. We heard a lot of it too. Like if you're in a deal and your loan's coming due and you either have to sell or refinance. Refinancing is probably not an option. So a lot of people are extending these loans. But as we learned the other day, if they had a rate at 3.5 and the loan's coming due, a lot of these people are 2 points above prime, right?
I want to get to that. I want to talk about refinances
Yeah.
and loans that are coming due, but
Yeah.
getting back to acquisitions for a minute and where rates are. So you said high sixes. I heard I spoke with a mortgage broker this week who said he quoted a deal. There's a heavy retail component, but he quoted a deal at a 7% interest rate.
Yes.
From a bank in New York.
Yes.
So I think the days of interest rates in the 5s look like they're behind us at this point.
I haven't seen anything.
Hopefully that comes back down at some point in the next few months or in the next year or something, but who knows? But like broad strokes, if we're at interest rates in the 6s, what does that do to cap rates and values?
It's a good point. I mean, there's certain buyers that are still buying at low cap rates, like which we're doing a lot of.
What is
business
a low
with.
cap rate?
Like anything in the 5s. I think if you're low 5 cap right now, I think that right now is a low cap rate.
But you have to be comfortable with your other metrics. I think the other metrics are going to defend that 5 cap.
Yeah.
Like your price per square foot is probably pretty good for the location. You're like, all right, I'm comfortable with moving forward. With what Derek said, like cost basis, like I think we're going to get into those metrics again really heavily. The price per square foot, the GRM. I think people are going to underwrite to those a lot more in this environment we're going into.
Agreed. 100%.
I think those metrics don't make any sense personally, but I get that people use them all the
What
time.
metrics?
Price per unit, GRM. I think they're just like
They don't make
look,
sense.
honestly, for me, I get the cost basis, and I know that I was arguing for cost basis last week.
Yeah.
But again, I just don't think price per unit or price per foot or I like price per foot actually, but I think price per unit or GRM are just really high level and don't really give you a good sense of what's going on.
Price per foot's a great metric, although a lot of this raised capital doesn't really look at that because they're yield based, and yield based has nothing to do with price per foot. It's really like an upside play and what you're buying the bricks for. But yeah, price per units. So that doesn't make any sense to me unless you're in the Bronx. Or
all right,
Manhattan.
so obviously I think cap rate. I mean, that's really the number one thing I look at, and,
sure.
and interest rates and IRR and cash on cash and all that. But over the summer, we saw so many deals getting done in the 4 cap range, 4.25 to 4.75, just touching a 5 cap. And are those days over or are they not over?
That's purely because of interest rates also were not where they are today.
True.
They were in the 4s in the summer. They were.
Yeah.
So that's a lot better than where they are today. So that's number one. And number two, the rental market in New York City in the summer was out of control, and people saw that, and they were overcompensating. They were saying, okay, I'll buy a 4 cap or a 4.5 cap because rents are just going up and up and up, and I'm going to rent these units for so much more. And
They're
I'll
betting on
level
upside.
out. Yeah, and now rents are leveling out, and in a lot of cases going down.
Also, those properties that sold those cap rates were like the creme de la creme, like tax class 2B, got renovated, as clean as a whistle, well located.
Or just well located.
And you guys were, a lot of those were sold to funds that were getting funding internationally and getting far cheaper debt than the U.S. sources that you can get from most buyers. So
100%. Who even knows what those costs, what their borrowing costs were on that equity?
Yeah.
100%.
Okay, so, all right, did we answer the question where cap rates, if interest rates are like at 6% now? Like, I mean, we said stuff in the 5s, but there's a growth opportunity, but we have a lot of activity. How do we have so much activity?
I'll tell you. So
based on where cap rates are and where the values are.
I'll give you an example from like yesterday, right? We're doing a deal. It's an 8-unit building in Brooklyn. It's fully gut renovated, and obviously the sellers have to do something, right? They're either going to do a cash out refi or they're going to sell the building. So we're talking to them on the phone. They're asking us to counter at a very large number to the buyer, one that I didn't agree with, and I had a discussion with them and say, guys, what's the options here, right?
Mm-hmm.
Like, I think your building's worth, it was honestly $6.7 million, and they wanted something with a 7 on the front. I said, it's not going to happen. I'm like, but like, let's put that on the side for now. What about refinance? Where are your quotes? And I'm looking at their NOI. I know that they're not going to get a loan for more than $4 million. They obviously quickly.
Do you know the NOI offhand?
Yeah.
What was it?
I mean, I'll tell you the monthly gross was 33,700.
I think what was the net?
33,700 a month.
350.
350.
It was 350. It was 355 or something like that.
350 NOI.
Yeah,
around there.
And, and I said you'll be lucky to get a loan.
Four
with
and a half, yeah.
No, dude, they're not going to even get 4.5. It was. I don't even know if that's NOI. I ran at like low 4s or barely getting 4, and they agreed, and we're like, okay, so that, and they're into it for way more. So that's not a good option for them. So they know that on a refinance, they're not going to execute on a refinance because it doesn't do what they need. It's not enough money in their pocket, and they're going to be sitting in the deal for another 5 years.
Do you know what their current loan amount on the property is?
So on this particular deal, they bought a vacant building, they gutted it, and they took a loan out at $4 million.
They have a loan for $4 million. Is the loan coming due?
I'm not sure when it's coming due. I'm not privy to that, but I know that they're not going to get a big enough refinance to take them out and give them money.
All right, so let's just talk about this real quick. So I just pulled out my my mortgage calculator, which is an app that I used from Eastern Union. I like this app a lot.
Okay,
Nice plug. Nice plug.
Well, I mean, there's no plug, but the app is.
Maybe there should be. Maybe Eastern Union should.
All right. Well, if Eastern Union's listening, they can reach out and send us a nod for using their app because it actually is really damn good, and there's a lot of different calculators on here that are super easy. But anyway, I'm just going to plug in first year NOI. I'm going to put it in as 320.
And again,
I'm going to say
300. It was a 350 NOI.
You're right.
And
350?
Yeah.
We'll put in a 350
hold
NOI.
On a broker NOI, you know it's going to be stress tested a lot more from the bank.
For sure.
This is our NOI, 3% vacancy, 3% management.
I mean, you said this is an 8-unit building where values are coming in the high 6s, so those rents have got to be like very high rent. Those rents are going to be stress tested as well.
Yeah.
The NOI
it's a lot of stress
to a bank may not be 350, but let's use 350. So
it's not going to be.
So 350.
That's what it was on our numbers. Yeah.
Okay, let's be fair here.
Our numbers, we're using a 350 NOI.
Yeah.
A lot of banks use a 1.3 debt coverage ratio for underwriting, so I think that's a fair place to do it. I'm going to put this at a 3.25% interest rate on a 30-year AM, and that gives you a $5.1 million loan.
Okay.
So a couple months ago, this thing could have potentially been refied for 5.1 on like a $7 million valuation or
what
something.
What interest rate you put in?
3.25.
So this is like many months ago.
I put in a historic historic interest rate.
Gotcha. So
going back in time
Gotcha.
to basically say like what they might have had in mind and what they could have realized not too long ago, maybe like I don't know how long ago, 6, 12, 18 months, somewhere in that range.
So let's drop the current numbers in there.
All right, so now let's put it at a 6
He's
and a
all
quarter.
into it for that number.
And keep in mind, when I said, just for the record, when I said you'd be lucky to get 4, that was in my head.
All right,
I didn't have a
in your head.
calculator.
No
so
problem.
if I'm wrong, I'm wrong.
So now, using the same NOI, 350,000 NOI, 1.3% debt coverage ratio, I put the interest rate at 6.25%.
Fair.
And a 30-year amortization, and you're at $3.6 million.
Look at that. I said you'd be lucky to get $4 million, and they agreed.
So you're down $1.5 million in your financing, and as a percentage of 3.6.
And they have an offer on the table they have an offer for 6.5 that they're trying to push this guy to $7 million, which is not going to happen.
I mean, the financing is down 30%.
Yep. And how do they get their cash out? They don't. They have to sell.
What did you say the loan was again?
They have a current loan on for 4, and that's high interest money because it was a construction loan.
Okay, so
it's construction and acquisition.
All right, fine. So let's talk about this. So it was construction and acquisition, and that could be coming due then. I mean, it's probably not a 5-year even. It could be coming due soon.
No.
So what's the loan on again? You said 4?
4.
Yeah. So they have a loan on it for 4. Here they're getting a loan quote for $3,650,000, somewhere in that range, and now they're $350,000 short on the refi.
And an offer on the table for $6.5 million from us.
Let's say talking about financing that they don't want to take the for sale option. They don't want to take the offer for $6.5 million.
Okay.
They want to just refi and hold. It's a good property, good rents, good location, free market, right?
Yeah.
Renovated. They're going to get a loan for 3.65, and their current loan is $4 million. What do?
They have 2 options.
Okay.
They either throw more money into the deal and pay, and they're gonna have to pay down that $4 million to 3.6. Obviously, the 3.6 is gonna have closing costs. It's probably gonna be like 3.5. Or they transact at $6.5 million, which is a huge number in today's market. I think it's barely a 5 cap. They take it, and that's their option. And these are the type of investors they need a transaction. They need to take money off the table. They either need to do a cash out refinance, not a cash in, cash out, or they sell. And we quickly figured out in that conversation that selling for 6.5 is it, because they kept on saying at the beginning of the call, if I don't get 7, I'm going to refinance. And I said, okay, what's your obviously had their NOI. I'm like, what do you guys think you're going to refinance for?
It's just so interesting how like the higher interest rates really takes a lot of options for people off the table.
Yes.
If interest rates are still in the 5s, they could refinance.
Plus, we all know banks aren't running to cash people out right now. They don't want to do that right now. Mm-hmm. They just don't. It's like an uphill battle just to get a good cash out.
Yeah.
So I think selling, if you have the right buyer at the right cap rate, it's an amazing option.
So, all right, this is a little bit of a unique example because this is acquisition and construction financing. Yep. So I assume maybe it's not like 5-year money, but let's just say that someone has a 5-year loan on a property and the loan is coming due. Maybe they could refi, but the numbers would probably be about the same amount as their current loan is, or maybe it'd be a little less than what their current loan is, and they don't want to do a cash-in refi. A lot of the loans have this whole rollover option where you could go into extensions. So say it's a 5-year loan or a 7-year loan. If you don't refinance before the loan comes due, then it extends into a new 5-year term. And my understanding is a lot of those terms are based on the FHLB, Federal Home Loan Bank rate, FHLB, which is higher than like the Treasury rate. And there's usually a higher spread too, like 275 basis points above the FHLB. So that would put interest rates in like the 7% range. But my question is, are owners that have loans coming due in the next 12 months, are they going to be forced to sell, essentially like the situation we just outlined? Or are they going to just extend and continue to kick the can down the road and hold on to the buildings and just see where the market leaves us in a few years?
All right. Well, let's use you here, right? Because we know you have that small deal.
All right, perfect.
And it's perfect for this conversation.
So we can describe it.
Yeah. Okay. Go.
It's no problem.
Yeah. And then you can answer what you're going to do.
All right. So I have I
love this.
Yeah.
I have a 6-unit.
Yeah.
It's half free market, half rent stabilized. I bought it 10 years ago, added value, did a cash out refi, got essentially all of our cash out of it. So I owned the building, with no earnest money into the deal. But there was a lot of equity. It was worth a whole lot more. And as the rent laws have changed, I've watched the value go down and down and down. And I had a loan. It was a 7-year money loan I put on it for like 1.1, and we've paid it down over time. But here I am, and I could refinance for 1.1, but I just didn't really care to deal with like the closing costs and like just deal with the refi in general. So my partner and I decided like 6 months ago we were just going to let it roll into the option, the extension. The issue there is interest rates have gone up so much that like we're just going to be paying so much money to service the debt. I guess in our case, like we still have a lot of equity, so we can continue to extend and pretend. I don't know if we have debt coverage ratio like requirements, but if we do at the higher interest rate, it could be an issue. And I could be forced to refinance. I'm sure, I haven't run the numbers on it, but I could. We'll run the numbers on it real quick.
Yeah.
My taxes went up on this deal.
This is an issue that a lot of investors are going to be dealing with, so I think this is extremely interesting.
All right, so I have $100,000 NOI on this deal.
Okay.
The gross is like 135, the net is like 100. Maybe it's even less than that.
This is a little 6-family in Bushwick, which a lot of our clients own.
For sure.
Yeah.
I'll put it at a 1.3 debt coverage ratio, a 6.25% interest rate, 30-year AM. It says I can get a $1,040,000 loan. I think I have like $1,040,000 on it now. So I could refinance this. I might have a little bit of cash in or a little bit of cash out. It's going to be pretty close.
Yeah, but it's
not
kind of
meaningful.
Is it worth doing all that though? Or are you better off just rolling it over?
Then I have to pay, potentially, I don't know. There's fees and there's headaches.
And you're not walking away with any money, so why deal with it?
But now let's look up the FHLB rate, okay?
Yeah.
It says, I had this in my phone. It says the current rate is 4.83.
Okay.
So I'll take 4.83 plus 4.83 plus 2.75 is 7.58, so 7.6. So let me put that same interest rate into this mortgage calculator here.
So just to be clear for people listening to this, so you basically had a rate of 3.5. If you take the rollover option, they're going to take that rate, which is 4.75 today. They're going to add 2.75 to it.
Yep.
So on a rollover, your interest rate on the same income is going from 3.5% to, you said, 7.25, right?
7.6.
7.6, which is a monster difference.
And I'm
On
just
the
going to
same
plug
income.
in. I'm just going to plug in how much this loan is going to cost me
Yeah.
at 7.6. So let me just find this calculator, mortgage calculator. Okay, loan amount $1,050,000, 7.6% interest rate, NOI 100. So this loan is going to cost me, when it rolls over in the FHLB, it's going to cost me like $7,400 a month.
Okay.
It said it's going to cost me $88,965 a year.
Okay.
Which is rounded up to 90,000.
Okay.
So now all of a sudden I have $90,000 in debt service on $100,000 NOI,
Boom.
and I'm going to fail the debt service coverage ratio requirements if the bank requires that or has that.
Yep.
I'm toast on that.
Correct.
Luckily for me, the building covers, and I can at least refinance. I don't have
Yeah.
to do a cash and refi.
Yeah.
But that's because my partner and I decided, like,
Too conservative.
back in 2015 or 2016, whenever we put the loan on it, we decided to go for like 65% LTV, and we did
is smart.
7-year money. We didn't, like, the way you max out the financing is you do 5-year money, and you go for 75%. You go for max financing. We didn't do that. So, like, luckily for us, we're like dodging like this bullet here.
So you're getting past like the skin of your teeth, and you had a conservative refinance. But how many people in the market didn't do that?
And you know what really
now are
got us?
dealing with this?
You know what really got us? The rent laws, where like all of a sudden we lost all the upside.
Correct.
And especially now with like the lack of ability to do combos too. Like, I mean, I don't know what the cap rate's going to, but it's going up.
And you had a little tax increase there
We
too.
we
you know, which
we
is
renovated those
unlucky,
3
you know?
units. We filed permits, and we got reassessed as the city's allowed to do based on our cost of construction. And
Yep.
the taxes went on a 2B building from like 9,000 to 17,000. So that took away, you know, we had like a 110 NOI that brought us down to like 100 on a good day. Honestly, the real NOI might be less than 100. It could be 95 or 90 when all is said and done. But yeah, I mean, so the question is, what are other building owners that have rent stabilized product where there's been no growth, the taxes keep going up? They did max financing in 2018 before the rent laws changed. Now, I mean,
They're in a worse situation.
even if they go into the rollover period, that's going to be so expensive for them to service that debt. They're going to be throwing money at the deal every month, losing money.
And on top of all that, another variable here is the increase in expenses. The heating expense. We're going to go into an expensive winter. Everything's up. Taxes are up. I mean, it's just it's almost like everything's working against you in that situation. And again, you were conservative when you refinanced.
I was very conservative, yeah.
Most people are not.
I've always been conservative.
For sure,
And
but
not that I own a bunch, but I do
Yeah.
own a handful of properties, and they've always been extremely conservatively
100%.
financed. Not looking to max it out. I always, on all the loans I ever took, I always stress tested the hell out of them.
I know.
Like, I stress tested all the rents, I stress tested all the expenses, I stress tested the interest rate, I stress tested the debt coverage ratio. Like, I looked at it from every angle to be like, okay, am I really legitimately safe here?
Yep.
Because, you know, I've been through 2008, 2009. I remember what that looked like, and I don't need to create issues for myself.
But having said that, there's going to be a lot of people that do have these issues, and this is a real market scenario today. So I'm happy you shared that because it's good insights, and a lot of people. This is a scenario that a lot of people are going to have to start dealing with.
So let's just talk this through. So these people's loans are coming due in the next year.
Yep.
And just like, what are they going to do? It's either cash and refi, which basically means sell, and they're going to get what? I mean, they're going to just. That's going to be brutal based on where cap rates are.
A cash and refinance is a very, very hard sell. Most people do not throw good money after bad, and any investment.
But even let's just say on my deal that I had to do a cash and refi, with where that property in Bushwick, that 6-unit, I think that was worth $2 million, probably in 2016, 2017, 2018.
yeah, or like a month before the
Yeah.
law changed.
And honestly, it was worth more before this new proposed regulation about combo units as well, because we have air rights there. I had and I have a ground floor unit that I was going to duplex
Yeah.
if I ever got them out.
Yeah.
So like there was upside avenues that I had,
Yeah.
which have just been taken off the table. So that just means my cap rate just keeps going up and up. And I mean, what is this deal even worth at this point? Like $100K NOI? How do you value this?
A 6-family in Bushwick with 3 free market and 3
6.5
RS.
cap?
if you can find a buyer for that,
So it's
worth a small deal with no real upside.
So it's worth like 1.5.
Yeah, at a good day.
And like it's just tough to stomach when you have like in your head that it was worth 25% more.
Yeah.
And you think that value should still be like intrinsically part of it, but it's just not.
So you're not doing a cash and refinance there. Why would you throw more?
So
money
in this
after it?
scenario, if I had to do a cash and refi, you think that I'm just a seller instead?
Well, listen, I know your situation on a lot of these deals.
But hypothetically
it's all our
speaking-
own money, so it's like, in your situation here, yeah, like you talk to your partner, or you talk to two other partners, and yeah, maybe it makes sense to throw some money in the deal, but that's your situation. A lot of this is other people's money, and it's raised money, and having an investor call and saying, hey guys, I know we got our asses handed to us here. But now we're gonna have to pay down the loan. So I need another wire to start paying down the debt. Who's gonna want to do that? They're gonna say sell it.
Especially
sell it. Yeah.
Sell it and give me back what I have in it, and on to the next.
Yeah, especially when the stock market is down,
Yeah.
people's net worths are down,
Yeah.
we're potentially heading
People are
into a
being-
recession.
Yeah.
Like
They
people
don't know where they
trying to
stand.
are trying to hold cash, not put cash into like these existing deals that have already
Yeah.
just gotten beaten like from every direction.
100%. That's a conversation that I don't, unless it's a very good location and you know that this is just a bad time and it's going
Or
to
you have
come
a
back.
lot of money.
A lot of equity. Like, that's a different situation.
Willing
but
to sit on it.
A lot of these deals that we're discussing, like, someone's going to say, hey, let's sell it. Let's move on and on to the next. And that's a good option for a lot of these people.
And that's a really exciting option for brokers.
Yes, it is.
It's unfortunate for principals that have to face that, but this debt that people take
But they also took on they also took a lot of their money out on the cash out refi that they did in 15 or 16.
if they did a cash out refi. I mean,
Or
some of these
18.
people did acquisitions, but
Yeah.
the crazy thing about the way commercial real estate works, where you have like this short-term money that balloons, like 5-year, 7-year type of deals, it forces people to do stuff. I mean, you're forced to, at a minimum, refinance every few years. And if the deal doesn't go the way that you want, you're essentially forced to sell. It's interesting how like the system is set up to like constantly create transactions.
Yeah, well, the debt,
debt.
It's crazy. I mean, when I started in the business, my dad always mentions that. He's like, always watch interest rates, because you don't really think about that as a broker. He's like, 3% interest rates. That's a complete joke. And people are buying these buildings on these, on tight numbers at these really low interest rates, and people act like they're not going to go up. And the fact is, interest rates go up, and it changes the entire game. And you refinance a deal, or you finance a deal, with this in mind. I mean, interest rates, debt changes the entire game.
I remember we were speaking with a big owner at some point a year or two ago. I remember you're the one who relayed this information to me, but he said debt forces you to sell.
Yeah.
Like, you take on debt and things look different, whether it's interest rates or rents or your expense numbers, and whatever it is, you could be forced to sell.
The people with a lot of money that buy deals, they either buy them cash or they put very low leverage. They're levered to like 50%. They put a lot of cash into these deals, and that's the right way to buy these. Obviously, most people don't do that, or they can't do that, and that's not a good way to have a real estate business.
But you're also describing the profile of a non-syndication type of buyer. You're talking about the long-term holder, the private family office.
But those people, like what you're describing, those family offices, those long-term holders, they're not going to be forced to sell because of an interest rate hike.
Right.
Yeah.
But dude, on the flip side, think about like the young guy that comes in like in his 20s and starts buying deals and adding value and renovating. Like, this is going back a few years when that was like all over the place, and refinancing, cashing out, buying another, adding value, refinancing, cashing out, buying another.
The old Burr method.
What is it?
The old Burr method. Buy, renovate, refinance, repeat.
Okay.
Burr.
Burr.
That's the best way.
But you saw these people build these massive portfolios, all on leverage, but like all of a sudden these people are sitting on 10, 20 buildings levered up, and if shit doesn't hit the fan, those guys are done. Game over. Ring the bell. They have enough money for the rest of their lives.
Correct. It's the best way to build wealth in real estate is that method.
So it's just such an interesting dynamic in terms of like people's risk appetite for leverage and what that can do to get you to succeed and have like, to have just create a ton of wealth through real estate versus the flip side where the market dynamics change and you're in some trouble.
100%. Couldn't agree more.
So, yeah. I don't know. So what are we talking about here? What else is there to go over?
I'm going to be honest.
Yeah.
I'm not trying to cut this short, but we had a lot of information, and that was a lot of good information there. I think it's a good place to stop. Well, let's see where things go going forward.
You guys have anything you want to add?
No, I just think it's like in the future, going into next quarter, Q1 of 2023, I think it's going to be interesting to see where rents go. I'll be very curious to see where rents go.
Let me put one last thing in there. Going into next year, going into next quarter, how do brokers make money? Where's the money at? Where are the deals?
Like an asset class or
Anything.
Well, I think, listen, people are always going to sell. I think as brokers, we've heard this a lot. Things happen in the market. It might slow down, right? Like obviously, 2020 was a slower year for everyone, and 2021 was a booming year for everyone. So there's going to be slow times in the market, and that could be coming up. But I think this last quarter, I think you're going to see a lot of people sell and transact because of the tension we described in the beginning of the podcast. Where sellers know interest rates are going up, so they're rushing to do a deal. Buyers know the same thing. They're trying to get deals done because they know interest rates are going up. They're trying to lock in the best rate they can. But it's also a quarter of people coming to be realistic, right? Like, I think right now prices are still high. You definitely see that in the residential market where prices, like the transactions in the residential market have really slowed down. They've slowed down to almost a halt, but pricing hasn't changed.
I ran comps in...
1 second.
Yes.
1 second. No,
sorry.
hold on. No, it's
Go
okay.
ahead.
It's okay. But it's come down to a halt because sellers haven't come to grips with it. They haven't lowered their prices, and I think you can see that a lot in the investment sector as well, where people probably still want yesterday's numbers, and they're fighting. But come Q1 of 2023, I think they're gonna see the writing on the wall, and sellers are gonna get realistic, and there's gonna be people selling deals, and it's going to be more transactions. But go on to what you're saying.
No, it's honestly, it's irrelevant. It doesn't matter. I was just saying that I ran comps and I saw. I mean, it's the comps. It's obviously really a trailing indicator.
Yeah, for sure.
It's like super trailing.
It's old. Yeah.
It's such dated info because who even knows when the contracts got signed. But I ran comps for the residential market in Park Slope where I live. I was just looking at townhouse comps recently, and
you're counting your money on your house.
Not really, but the numbers were still very, very good. I was very surprised to see just the deals that are still getting done.
Well, listen, in New York, I think New York City is a rare market. These people that are buying townhomes in Park Slope and Manhattan or wherever they're buying, they're very high net individuals, and a lot of these people they don't take debt into consideration. They're buying these deals cash, and that's a hell of an opportunity.
Most
too.
in Park Slope are taking on leverage, but everyone's putting down a sizable chunk of equity.
We talked. We have a lot of friends that are in the high sale point residential market in New York, right? And they said like over 10 million, no one takes a loan.
Yeah.
So think about that. How many deals sell for north of $10 million in New York City? These people aren't even taking loans. This is not even a thing that crosses their mind.
So I think we can wrap up here.
Yes,
I don't want to talk about the hypothesize about the residential sales too much here. All right. So any last comments? We good? That's it.
Good.
I'm done.
Thanks, guys.
Thank you. Hell of a podcast.
Think so?
Dude, that got in deep.
You think I got in too deep?
Dude, people want. This is what the listeners want. They want to hear real life things. We talked about a real life deal and how these people are fucking idiots. Like, that's crazy. And then your deal, like, this is like juicy stuff. Mm-hmm. This is not like broker bullshit. This is like juicy stuff.
Yeah.
I like this.
Yeah.
This is why people like the podcast. I'm telling you.
Yeah. For sure.
It's juicy.